Hi, everyone. Welcome to this live coverage. We are here with Yohay Elam from ForexCrunch and Mauricio from FXStreet to cover live the Bank of England monetary policy decision. As you know, the central bank is expected to keep its policy on hold, but we have also the quarterly inflation report. So maybe we get some reviews to grow on inflation and the food statement and the minutes of the meeting. So it's a super Thursday, right? Hello, Yohay. How are you?
Hi, Valeria. I'm doing great. And you? All ready for Mark Carney and his friends?
Yeah, eagerly waiting for them.
Yeah, this time, as you said, it's Super Thursday, and I think the Bank of England will probably upgrade the inflation and growth forecasts, basically because growth has been better than expected, and inflation has been stronger than expected due to the weak pound. But last time he said that rates can go either way, either up or down, not dovish anymore. I don't think they will go up despite higher inflation. What kind of hints do you expect today from the BoE?
Yeah, indeed. The market is waiting, wishing, I believe it's the best word for a rate hike. Although I don't believe the bank could deliver a rate hike, not this year and probably not next one. Who knows, Brexit is a big part of the way, right?
Yeah, I think, well, their forecasts have been low because of Brexit. Maybe they'll be upgraded, but I don't think they'll be upgraded too much to warrant a rate hike. I don't think they can be all happy at once because the economy hasn't fallen off the cliff, but this level of uncertainty is high also in the US, also in the UK. So
yeah, uncertainty is the new normal.
Yeah,
right?
Exactly. So Carney's dilemma, as I see it, did also on my morning show yesterday. The economy still looks good, inflation is rising quickly, and the pound may be a bit too weak, although in recent days it has gone up a bit. And on the other hand, we have Brexit, and if they do raise rates, if they do tighten or do less QE, it can lift the pound, push down inflation, but also hurt domestic demand, less lending. So I think they'll make, of course, no decision. Also no specific hint now. Wait for Article 50, which is due next month. Wait for Trump's 100 days, although I think we already have some kind of picture about Trump. And I don't see them raising rates. I see them trying to avoid that in any case.
Okay. Well, yeah, they're having a big year ahead. Interesting. About the needs from the Fed. Fed was quite neutral yesterday, and it's unlikely they will rise rates more than 2 times, hopefully, this year after such statement, because I believe that the most odds we have for the Fed moving this year is June and December. I believe that by March, when we get to those first 100 days you mentioned, then we may, and the Fed also, get a clearer picture of what's going on, right? So then it will be the time for the Fed to make some kind of announcement towards the future, prepare the markets. So actually, the hopes for a 3-rate hike triggered by the dot plot last December have become null. I believe that hopefully we can see two. And that's what's waiting on the greenback these days, more than, of course, alongside with Trump and his too strong dollar comments. But well, anyway, the pound it's advancing pretty firmly based on data. And I'm not sure if these movements are sustainable. I'm not sure how the market will react to a hawkish Bank of England. Yes, hawkish stance from Carney usually means a sharper, stronger pound. But could that be the case with the period at these levels? Honestly, I don't know.
Yeah, I agree. I think Brexit is still a huge uncertainty, a huge weight on the UK economy. And I think Brexit trumps Trump. The pound does have room to the downside, especially with the current rise. What levels are you looking at?
Yeah, well, I put out my daily charts because I'm watching the 2770 high we had in December, right? That would be sort of a line in the sand because we have sort of a double floor in the daily chart, with that being the neckline, right, of an inverted double floor here. So I, I'm not sure, but technicals are telling me that if the price moves above this 2770 region, it could really recover sharply, right? So I don't know what is. That's the level I'm watching right now, 2770. That's the main distance, of course, on a break above today's high.
Yeah, it's also very close to the initial post-Brexit low that we've seen.
Exactly. Also,
Exactly
that's
where
next around 28 something, but little. Also, if we can move beyond that level, it seems likely that the pound could rally even up to 28.50. Those are the levels I'm watching today. I know it's 200 pips away from the current level. I know it's a bit too much, but that's what I'm thinking. And towards the downside, of course, the 26, 25.90 level is my first support, because the loss of the 26 area would probably discourage a bit bulls or force them into profit taking, and therefore the pair could retreat further. But 25.20, it's for me the lowest we can see the pound today, unless we have a really shock coming from the Bank of England.
Yeah, no, I think they have no choice but to raise forecasts. But I think that Carney will follow Draghi, will take a page from Draghi's book, that sort of seeing the glass half empty of inflation. It's because of energy prices, transitional factors, not core inflation, not yet, let's wait.
Yeah.
Kind of stuff.
He has not much choice but to do so.
Yeah.
And what do you think about the euro going? It's going.
I think the euro recently is moving, well, mostly on Trump, mostly on disillusionment from Trump. Less talk about fiscal stimulus, more fighting with most countries on the planet. But also, it's important to remember that this week we had some positive data from Europe. We had inflation jumping to 1.8, growth forecasts beating with 0.5 instead of 0.4. And also good news for the real economy. The unemployment rate fell from 9.8 to 9.6. So,
yeah, market PMIs also rose at the beginning of January to multi-year highs. So overall, it seems the euro area is recovering, right?
Yeah. My anecdotal evidence from here in Barcelona, Spain, is that economy is improving. Wages are still low. People are still complaining, but finding a job at least is becoming easier, especially in the tourism sector. So you do see a positive change.
Right?
Yeah. Something is better than nothing. So
yeah. I'm still following that retracement between the November, January decline in the euro dollar. And we were discussing about this 820 region a couple of weeks ago when we met. And here we are pressuring the 50% retracement of that level, of that fall. And we also have multiple relevant lows around 800, 840 from the past 2 years. So honestly, I can see the pair rallying if we break above those levels. I'm not sure if today, because the Bank of England is not big influence for the euro dollar, not usually, but tomorrow with payables, who knows?
Yeah. Actually, US data published yesterday was better than expected, both the ISM non-manufacturing PMI and the ADP non-farm payrolls, and that gave the dollar an opportunity to recover. But I think that the bias trend is still against the US dollar, no?
Yeah, the recovery was short-lived and quickly reverted. Somehow that's telling us that the market is not willing to go along the greenback just yet.
Yeah.
The market needs catalyst, and payroll can't be that catalyst for me. Not anymore.
Yeah. No, used to be the king of Forex indicators. Maybe it's still the most important economic release, but politics has center stage now.
Yeah. It could, of course, support the greenback in the short term, right?
Yeah, if we have wages above 3%.
Yeah, something like that. Okay, waiting for Carney and Co. How long it? Oh, 4 minutes, less than 4 minutes.
Yeah. We also have a speech by Mario Draghi at 12:15 GMT.
Oh.
So that's about in 20 minutes. I don't know if he's going to talk about monetary policy. So the title of the speech, or he's going to speak in Slovenia, due to speak about Slovenia's 10th anniversary of the adoption of the euro at a joint conference by the European Central Bank and the Bank of Slovenia.
Okay. Let's pay attention to him also, because nobody knows what he can say. He has become more discreet with time, at least, but let's not expect a big shock from his wording.
Yeah. Let's get back to the pound chart. Range for today, as I have it, at least 126.34 to 127.05. So we're now basically in the middle of that range for today.
Okay.
Guess pound is waiting for Carney.
Yeah, we are also.
Yeah.
A sharp recovery was in the Aussie. It finally broke the 75, 76 range. It has been trapped for over a couple of weeks, right? It has been trading range bound between 75 and 76, and finally broke higher. I remember we talked about this last month, I believe, about the Bank of Australia, the Reserve Bank of Australia, becoming nervous if the pair surpasses 77, right? But it seems unlikely they will take any kind of material action, right? Maybe some showboating, but that's most the bank can offer these days. So beware of that, because if the pair keeps running, 78.30, if I'm not wrong, is 2016 high from April or May 2015, then the pair will probably reach that level. Above it, then the Reserve Bank of Australia may become really nervous and act, but not before.
Yeah, we had some positive figures from Australia tonight. Building approvals dropped by 1.2%, but that was better than 1.7 expected, and the trade balance came out at a much higher surplus than expected, 3.5 billion instead of 2 billion. So I think provided the excuses for the rally, and of course Donald Trump.
Okay, 1 minute to go. Remember, guys, we have a little delay. Okay, there we are, less than a minute. Let's go. Everything's unchanged. The assets for trade program is unchanged. Interest rates are unchanged. All 9 members vote to keep rates on hold. So let's wait for them to read a bit about what we have ahead. Little reaction so far in the pound, but holding at highs.
A bit higher, but well within the
Yeah.
range.
Yeah.
See if we can get information. Okay, the decision was unanimous regarding the interest rates. 9 voted leave it unchanged. No one opposed. Same goes with the QE.
Some members were increasingly concerned about inflation, something we already know it will happen.
Yeah. So, well, now the pound is turning a bit down. Well, off the highs back to.
But trading. We had a session low around 26.35, right? So it can gain bearish momentum below.
$1 is now beginning to descend. 126.40 and lower.
Since they have a
falling fast.
Okay, the risk outlook for
They didn't change the inflation outlook.
Yeah, and they repeated that they have limited tolerance for inflation above their 2% target.
So that's the reason why we're seeing the fall.
Yeah. Okay, the Bank of England still sees inflation averaging 2.6, 2.7% this year and the next, hoping it would slip back to 2.4 in 2019.
Yeah, who knows what's going to happen in 2019?
Who knows if we are going to be alive in 2019. Okay. More optimistic on our market, household spending. I can't find the figures on growth. So almost non-reaction in the rest of the market, but some modest dollar advance given that the pound is falling.
Yeah,
right?
Euro-dollar ticking down just a bit.
Yeah. Less than 10 pips, so nothing really relevant. Super Thursdays are not so super late.
Yeah. A bit more super than the Fed yesterday.
What?
No?
What? Sorry.
We're seeing a bit, the movement we're seeing in pound dollar are a bit more than what we've seen yesterday with the Fed.
Yeah.
No, or not really.
More or less the same little reaction. Yeah. Politics have stolen the central stage to central banks. Something that will probably persist all through this year.
A bigger fall now in the pound. Pound dollar already new low of 126.22. It's a low for the day.
Someone's asking what are the levels of trade for today's GDP dollar. As we said, a break below that previous low, daily low, session low, 26.35. Sorry, it's favoring the downward extension. Now probably heading towards 26. The next support for me comes around 25.60 and 25.20. No, sorry, the levels I'm looking. I would rather wait until the market ends up digesting the full statement before taking the positions. But if the pair loses the 26 level, there's likely bearish continuation ahead for the pair. Short to one because the dollar is quite weak. and at this point seems only with a break above the daily high, right around 27.05. The pair can extend its gains, and then the next probable bullish target comes at 27.74, which is December monthly high.
Yeah. I see low support there at 125.40, but that's a bit far off, especially with the magnitude of the moves that we're seeing so far. So, yeah. So I think the Bank of England prefers seeing the glass half empty with inflation forecasts.
Yeah. They can't risk much. The uncertainty is also huge in the United Kingdom, not only because of the US and Trump, but also because of Brexit. So they have little room to maneuver, right? Central banks, I mean.
Yeah, I think that Carney and his friends would prefer a slightly stronger pound, but without having to act. That would result in less inflation pressures, but without hurting demand, without hurting lending. But it's hard to eat the cake and leave it whole, or whatever that expression has been. Anyway, the pound so far is reacting negatively.
Yeah. All alone, the pound in its move.
Yeah. The low on pound dollar is 126.13. We're a bit above that, but not going anywhere fast.
Yeah, I mean, maybe some policymakers have expressed their concern about higher inflation, but they are still thinking that it will remain unchanged this year and the next, and only waiting for a slight retracement in 2019. Somehow, that's telling us that they're in no rush to act against rising inflation, or that they prefer to ignore it at this point. So that means that the rate hike in the UK is moving even farther away, and that's why the pound is now falling. Pretty much, that's the most we get from this super Thursday. That it was not that super anyway.
Yeah, but at least we have a range of 100 pips.
Yeah, interesting. And I do believe that there's still room for further pound declines. Investors are rushing to price in future moves, and ahead of this, the market was pricing in some kind of concern coming from Bank of England about rising inflation. Something really relevant, like saying, okay, inflation it's getting too high, we stand ready to act against it, but we didn't get that, and that's why the pound is giving back its latest gains.
Yeah, new loads here, 126.05. Sorry?
I was thinking we have some minor employment reports in the US, which are not usually relevant, but will be today because we have payrolls tomorrow. If those are positive, maybe the dollar can extend further its gain, at least in the short term, right? I mean, as you said earlier, the dollar is bearish. And we have rally in 5 minutes.
Yeah, but as we mentioned before, we don't know if the speech is about monetary policy or just about, I don't know, the euro, Slovenia, or things like that. So
yeah, probably about the last. Okay. Testing 26. How about the dollar to Venezuela? Barely reacted, right? Yeah, holding near 12.
Yeah, the weakness of the US dollar is best reflected in many cases in dollar yen. So this is the case now as well, I guess.
That one will give us some good trading opportunities in a break below 12, It will probably enter a bearish continuation, and you know that when the dollar to Venezuela enters a move, it hardly looks back. Either side of the board, in this case, it's entering in a bearish market. Many years ago, the dollar to Venezuela, not many years ago, 5, 6, 7 years ago, the dollar to Venezuela tend to fall in February and March because of fiscal policies in the country, right? That forced them to bring back money home ahead of a close of the fiscal year in Japan, which is on March 31st. That policy changed, but the market keeps supporting the stronger yen in this time of the year, February, March. So odds are always towards the downside for the pair in this particular 2 months.
Yeah, seasonals are strong. Can't always explain them, but well, in this case, we do have an explanation from the past.
Yeah, from the past, but the market is like not willing to give up to that change in legislation in Japan. Okay, holding above 26 the pound so far, but pressuring the level. Carney will speak in about 15 minutes or so. Oh, well, maybe he had something, right? Something interesting to the market. What do you think about oil and the big rise in there? I know you don't follow it too much, but
I do follow oil. I think there are a few reasons. First of all, for the rise of oil is, first of all, the OPEC members are mostly implementing the deal, so it's good for oil prices if production is really cut. And there's also, I think, the return of the inverse correlation between oil and the US dollar.
Yeah,
so
from that side, most correlation against the greenback rather than production, because yes, production is rising huge,
Yeah. Yeah, we're at 54.17 on WTI. Next level I see is 54.50 and then 55.20, which was the
high
cycle high. Mm-hmm.
Okay, let's see if we get something from Super Mario in the Super Thursday. Something interesting going on? No, right?
Looking for data here. Well, it's 12:15 GMT, so the speech by Mario Draghi is supposed to be out, but I don't see any reaction.
He's probably saying nothing relevant.
Yeah, there's also a chance that the news isn't out yet, but I believe it isn't that important. What is important for markets now is the Bank of England. They released their quarterly inflation report. They didn't change the inflation forecasts too much, and that weighs on the pound.
Yeah. The Aussie is happily rising, ignoring the rest of the market, mounted
Yeah.
to upward momentum.
Really stands out today, Australian dollar.
And stocks are doing not much. European equities are pretty much unchanged daily basis. Dow US futures are also flat. Nothing going on there. Euro is so willing to break higher. It just need a little push to do it.
Yeah.
It's so eagerly hoping to break higher.
Yeah. On the verge of. Yeah. Settling above 108, but not going anywhere fast.
Yeah. Okay. Not much until Carney's press conference.
Barney begins speaking at 12:30 GMT.
Carney, yeah.
In the past, do you remember if he had a big impact when he spoke?
Just right after the Brexit, I believe that.
Oh, right.
Was the first time, and then one time he gave a little impact.
Yeah.
Let's give it some minutes and see if he had impact in the market.
Yeah, pound dollar currently found the temporary low of 126.01, and it's not much above this level. It's about 100 pips down from the high level of the day. For more information, let's see if we can find.
Yeah, actually, there's nothing much.
Yeah. Tomorrow, of course, the big event is the non-farm payrolls. According to early indicators, it might come out better than expected. If we look at ADP, at ISM manufacturing, but it's always a wild card. And I think wages will be more important this time than the headline figure, or at least as important.
Yeah. We are going to have, I'm asking Mauricio if he can please give us live Carney, and he will. So we are going to have him live in here at least a few minutes and see if market has some reaction to his wording. Okay, crossing fingers.
Yeah, I think now at least pound dollar is a bit of in a wait and see mode.
Yeah.
After the big fall or medium fall.
Yeah. If the bank, if Carney is even more cautious, then it will probably fall farther. Beyond waiting for Carney and beyond the resilient data we had lately coming from the UK, do you think that this growing path will persist in the UK with the Brexit? Meaning, at some point, a cheaper pound will imply much higher costs, right, to companies in the UK. So at some point, it wouldn't be that great to have a cheaper currency, right?
Yeah, I agree. I think well, cheaper currency in theory is supposed to help exports. In practice, for the UK, in the UK's case, a country that imports a lot, has a wide trade balance deficit, it means less money in pockets of consumers, and that means less activity in the economy in general. So adding to the uncertainty and less investment coming from Brexit, I think perhaps the fall of the pound went a bit too far for the UK. I don't think it's helpful at the moment.
It won't mean anyway that the pound will reverse course, right?
No.
It will rise because just of that. It would only mean the UK economy will be in deeper trouble, and probably the pound will fall further, and probably there will be more chaos. So they're heading into a tough situation. The Parliament, the first house, one of the houses of the Parliament, the Commons House, I believe, approved the Brexit bill, right? Today already?
Yeah, I think it's the first step, and
Yeah.
there's a bigger vote next week, more important one. A complicated process. As far as I know, the big date for triggering Article 50, the notification to the European Union, is March 9th, but it's not a final date. And from that moment, it'll be a countdown of 2 years.
Yeah.
In the meantime, pound dollar dropped under 126, 125.90 at the moment.
Yeah.
So we're waiting for Carney to speak.
5
in
minutes.
the next, yeah. We're heading to new lows there, 125.85.
Yeah.
All the other currencies are very stable. It's naturally the focus is on the UK.
Practically ignoring what's going on with the pound.
Mm-hmm. Yeah. So already 90 pips below the level seen just before the data came out. 25.80. Yeah.
Okay. Waiting almost over, Yohay.
Yeah. Mark Carney. Yeah.
Anyway.
The George Clooney of central bankers. Or something. Yeah. I think this week we had quite a few big events. Bank of England, Federal Reserve, non-farm payrolls. Next week we have the Brexit vote, probably. Yeah. And any other?
Quieter one. I mean, this time everything happened this first week of the month.
Yeah. I think that also in Australia they have a rate decision next week. The first one for the year. Yeah, on Tuesday, February 7th, Reserve Bank of Australia will make its rate decision. Let's see if they have anything to say about the strong Australian dollar, at least what we're seeing at the moment.
Yeah, that will be a bit more interesting. Still, the mining sector, base metals maintain their strength. Base metals have been among the first to rise after Trump's victory and or his pledge for infrastructure investment. That sent base metal higher, such as iron, copper, and so on. The fact is that over these past 2 weeks, the market is unwinding such Trump trade, and that's why we're seeing stocks retreating, the dollar falling so hard. But still, commodities, and I mean metals in particular, are still strong. That speculative trade has not been unwind, and on the contrary, they are keep on rising, and that's one of the reasons the OC is so strong, also because Australia is one of the biggest exporters of base metals. China is one of the biggest consumers, right? And China is posting healthy readings, macroeconomic readings, I mean, raw figures are stable. GDP was modestly higher in the last quarter of 2016. And manufacturing data is strong. Remember, at this time last year, we were concerned about the economic slowdown that the world could suffer because of China. Those concerns are long over, and that's another support for the OC bullish case.
Yeah, everybody was talking about a hard landing, and the stock markets in China crashed. Now China is off the radar. Okay, time for Carn, you know it.
Yeah.
12:30 GMT.
Are we going to get it, Mauricio? Okay.
You see the picture here in Carney and his colleagues. Inflation report.
And
we can't hear anything.
Yeah, no sound.
cannot hear Carney at the moment.
Yeah, he's working on it. His Mauricio's
Okay.
working on it.
Anyway, the pound dropped so far.
Effective investments. Households' confidence in the economic situation will help determine their spending. And with time, the UK's economy's supply will be affected by a new set of trading relationships with the EU and other countries. The MPC has long emphasized that the effects of the process of leaving the EU on inflation would be the product of its impact on demand, supply, and the exchange rate. And it has consistently stressed that as a result, the implications for monetary policy would not be automatic. During these exceptional circumstances, the MPC is required by its remit to balance a period of above target inflation with a period of weaker growth. The primary objective of monetary policy remains inflation control, however, which means that any overshoot of inflation above target can only be temporary in nature and limited in scope. As such, the MPC has been clear that its tolerance for above target inflation is limited. Today's decision reflects the committee's updated assessment of those forces and those limits. The committee has unanimously confirmed that the current monetary policy stance remains appropriate, but it has also made important revisions to its forecast and highlighted some of the key judgments underlying it. Growth has remained resilient since the referendum, with the UK posting the fastest rate in the G7 last year. The MPC expects growth to be stronger over the forecast period than in November, with the economy now projected to expand by 2% in 2017 and 1.75% thereafter, or around 1.75% thereafter. This upgrade will leave the level of UK output around 1% higher over the next 3 years than we had expected in November. This stronger outlook is the product of 4 factors. In descending order of importance, they are: first, the Chancellor's autumn statement eased fiscal policy over the coming years, and this explains about half of the forecast upgrade. Second, the outlook for the global economy is firmer, reflecting an easing of fiscal policy in other major economies, together with improvements in financial conditions and business confidence, particularly in the United States. And that explains more than a quarter of the upgrade. Third, financial conditions in the UK remain supportive, underpinned by low risk-free rates, the 18% fall in sterling since the November 2015 peak, and lower credit spreads. Moreover, domestic credit conditions are accommodative, reinforced by strong competition in consumer credit markets and historically low mortgage rates. In part, this reflects the Bank of England's policy actions, which have also helped lower the impact of uncertainty on activity. And fourth, as was the case in November, there are few signs that households are cutting back spending ahead of the coming squeeze in their real incomes. With the savings rate falling towards pre-crisis lows and household debt picking up, how households adjust their spending and their expectations of future income will be important determinants of the outlook. Now, this stronger projection doesn't mean the referendum is without consequence. Uncertainty over future arrangements is weighing on business investment, which has been flat since the end of 2015. Business investment is expected to be around a quarter lower in 3 years' time than projected prior to the referendum, with material consequences for productivity, for wages, and for incomes. More broadly, the level of GDP is still expected to be 1.5% lower in 2 years' time than we had projected in May, despite substantial easing of monetary, macroprudential, and fiscal policies. Financial markets are already pricing in a material adjustment to the UK's economic prospects, as evidenced by the sharp fall in the value of sterling. Markets are valuing today what they expect to be necessary tomorrow. An adjustment to real incomes as the UK moves to its new trading arrangements. And the MPC expects the tension between current consumer strength and relative financial market pessimism to begin to be resolved over the course of this year. Turning to inflation, having risen markedly from around 0 in 2015, the MPC still expects CPI inflation to be back around 2% in the data for this month, for February. This largely reflects external factors. In particular, past falls in energy, food, and other imported goods prices begin dropping out of the annual comparison. Beyond that, inflation is expected to increase further, peaking around 2.8% at the start of 2018, before gradually falling back to 2.4% in 3 years' time. These overshoots are entirely because of sterling's fall, which itself is a product of the market's view of the consequences of Brexit. Consistent with this, longer-term measures of inflation expectations have risen over the past year from very low levels to stabilize around historical average levels and remain well anchored. The outlook for inflation in this forecast depends importantly on the path for supply, which is why the MPC undertakes regular detailed assessments of these prospects. And the latest in such assessment is incorporated in today's projections. Following a long period of consistently overestimating wage growth, the MPC has updated its view of the natural rate of unemployment. Specifically, we now judge that the rate of unemployment the economy can achieve while being consistent with sustainable rates of wage growth to be around 4.5%, down from 5% previously. As a result, the stronger outlook for demand is in large part matched by an increase in the economy's estimated supply capacity, and the net impact of these two factors on the inflation projection is broadly neutral. And as a consequence, when taken together with 3% appreciation of sterling since our last forecast, and the gently rising path for interest rates implied by market yields, the projection for inflation and the trade-off that the committee faces are both little changed relative to November. Turning to the policy decision, monetary policy cannot prevent either any structural adjustments that are necessary as the UK moves to new trading arrangements, or any consequences of those adjustments for real incomes. In the shorter run specifically, attempting to offset fully the effects of weaker sterling on inflation would be achievable only at the cost of higher unemployment and even weaker income growth. In such exceptional circumstances, the MPC's remit specifies that it must balance the speed with which it intends to return inflation to target with the support that monetary policy can provide to jobs and activity. At its February meeting, the MPC unanimously judged that it remained appropriate to seek to return inflation to target over a somewhat longer period than usual, and it also judged that the current stance of monetary policy remained appropriate to balance the demands of the committee's remit. As the committee has previously noted, however, there are limits to the extent to which above-target inflation can be tolerated. The projections described in the February report and the continuing suitability of the current policy stance depend crucially on three judgments. First, that the lower level of sterling continues to boost consumer prices broadly as expected, and without adverse consequences for inflation expectations further ahead. Secondly, that regular pay growth does indeed remain modest, consistent with the committee's updated assessment of the degree of slack in the labor market. And third, that the hitherto resilient rates of household spending growth slow as real income gains weaken. In judging the appropriate policy stance, the committee will be monitoring closely the incoming evidence regarding these and other factors. For instance, if spending growth slows more abruptly than expected, there's scope for monetary policy to be loosened. If, on the other hand, pay growth picks up by more than anticipated, monetary policy may need to be tightened to a greater degree than implied by current market yields. More generally, monetary policy can respond in either direction to changes to the economic outlook as they unfold to ensure a sustainable return of inflation to target. So to conclude, following the referendum, the bank eased macroprudential and monetary policies in order to support households and businesses during a period of initial uncertainty and eventual adjustment to the country's new relationship with the EU. That stimulus is working. The cost of borrowing is down, the availability of credit is up, and some of the impact of uncertainty on households and businesses has been mitigated. But the Brexit journey is really just beginning. While the direction of travel is clear, there'll be twists and turns along the way. Whatever happens, monetary policy will be set to return inflation sustainably to target, while supporting the necessary adjustments in the economy. At this week's meeting, the MPC maintained its policy stance. If circumstances warrant a change in policy, we will act consistent with our remit. And with that, Ben, Mauricio, and I would be pleased to take your questions.
And as always, can you please give us your name and the organisation you represent, and keep to one question for the first go round. Thanks, Marina.
Okay.
GDP this year.
Okay, he didn't add much new, right, Yohay? And in fact, he was a bit dovish, right? He didn't recount that inflation could rally. In fact, he said that any inflation overshoot may be only temporal, so he's not concerned about it. And well, remark the same that we heard before, that policy is pretty much a commodity, right? It could go up or it could go down, but without giving much clues on that.
Yeah, at the beginning he said our tolerance or patience for higher inflation is limited, but then actually we had to assess this patience, and basically it's a wait and see mode. If monetary policy can be tightened, if and only if I think wages will rise, and more than the outlook, and so far, as he said, they're modest, and if consumer spending is hurt too much, they can even be loosened anyway. Basically, inflation is higher, growth is higher, but the Bank of England remains neutral, did not move, did not allow the better economic data to move it. So
And he
it's,
will,
I think, dovish.
yeah, and we probably remain neutral more during the upcoming months.
Yeah, as you said, the Brexit journey is just beginning. So
Yeah, exactly. Okay, let's take a look at the pound. It's still bearish, pressuring the daily low, below 26. Strong retracement from 27. Further declines will depend on whether US data is strong enough, okay, to boost the greenback temporarily, at least ahead of payrolls, but don't expect much more action after US data, because unless, of course, we have more comments from our friend Donald Trump, because the market will tend to enter in wait and see mode ahead of payrolls, right? The American afternoon, that's what we're going to get today.
yeah,
The dollar remains overall weak, but the pound is weaker today.
yeah, Brexit trumps Trump, at least today.
Yeah.
For, of course, the main political shocks of 2016, which continue into 2017.
Okay, what do you think? We'll make a wrap up here?
Yeah, I think it's
Okay.
good.
It's a good moment, right?
Yeah.
Not much action. Okay, you go first this time, please.
Okay, so we had the Super Thursday from the Bank of England. The Bank of England, as expected, left interest rates unchanged, 0.25. QE program unchanged, 435. No surprises there. What made this super is the quarterly inflation report, and what made the movement in the pound is the forecast. New forecast for inflation is not much change from the previous forecast. Growth has been upgraded. Naturally, the Bank of England had to respond to better growth, but to higher inflation, it sees it as related to external factors, did not change the outlook, and is still very well balanced. I don't think they want to raise rates. Still a lot of uncertainty about Brexit. They say that rates can go either way. I think they'll want to keep it unchanged for a long time. Hopefully, the lower pound value will hold consumers back from pushing inflation too high, and wages won't rise too fast, and things will remain balanced, allowing them to not do too much. So higher inflation resulted in no change in inflation forecasts. This means dovish, and it hurt the pound, sending it about 80, 100 pips from the pre-release levels. Yeah, over to you.
Yeah. Okay. I'm not going to have much to add from the macroeconomic point of view. Technically, the pound this week, as I have just said, will probably keep on this path, particularly if upcoming year's data is encouraging because it's employment data and we have payrolls tomorrow. But, well, maybe not taking a look at the dollar, at the pound dollar cross, but then the crosses will be more interesting as if we have a bunch of negative data, probably the yen or the euro will appreciate further, and with the weaker pound could be the best pairs to trade during the upcoming American session, right? So pretty much, I do believe that's the most I have to add. And remember that central banks are no longer in the center stage. Politics will take the first place this year and will probably remain so.
Yeah, central banks react to what politicians do. The reaction is important, but they lag, they don't lead anymore. They're not the only game in town.
Okay, thank you, Yohay, for everything. Thank you, Mauricio, for being in the background, helping us to take this to everyone. And see you back soon, okay, guys?
Yeah, safe trading and bye-bye.
Thank you. Same for you and everyone. Bye-bye.